Well, let's jump into housing
All right.
broadly, as
Yes.
you labeled it, Matt. There's a new report from the National Association of Realtors, Residential Real Estate Snapshot, November 2025, which you correctly mentioned is some of the more recent data that we have. We don't usually get the data right away
Yep.
next month on a couple things that we do. So get us up to speed, Matt, on this report
Yeah.
because it covers the entire housing market and the economy.
So just before getting to home sales specifically, NAR touches on some housing demand drivers like GDP, steady around 3.1. That's pretty good. I think 3.2 is like the historical average or something around that. So 3.1 is pretty dang
Yep.
good. Federal funds rate 4.8% could be a little better, but so the plan is that it keeps going down. Inflation 2.7%, not too bad. Consumer spending also not bad. They have a graph of consumer spending here. I think it's easier to look at the year over year. And if you do look at the year over year, you'll see that consumer spending has leveled off at just a little higher than it was pre-pandemic. Now this is the PCE number, and that's I guess what the Fed uses. But again, it's not too bad either. I'll add a bonus here. So we're looking at the 10-year Treasury yield, which is actually this is the most frustrating graph here. I think with 10-year Treasury yields high and higher than the 4.36 number that it cites for November. It's much higher than that right now. But
Well, and it's interesting. His prediction shows that this was done, even though this is recent, how it's really out of date. However,
Yeah.
additional rate cuts to follow from the Federal Reserve. This is quoting from the
Oh, wow.
piece. NAR predicts that the yield will decrease to stay below 4% in the new year. Well, that narrative has certainly changed since
Yeah.
the writing of this, because now I think the base case is the 10 years going to be like in a range between maybe 4 to maybe to up to 4.75.
Yeah, that's a
in
really
much
good point.
higher range. Now, this also I think highlights how quickly the narrative can change. Because, for example, if we get some like very weak CPI prints, if we get if unemployment starts going the other way, we could start to see the 10-year start to fall really pretty quickly. It's just I think just we don't have the data to show us. But on the same vein, we could have the data that keeps the 10-year Treasury elevated, and especially we were just talking about whether it's tariffs or volatility. That doesn't typically be. We're not going to necessarily see rates come down if we see that kind of volatility and uncertainty with inflation.
So it is that Treasury yield that's a little shaky, a little more uncertain, a little potentially worrying, just frustrating, I guess. And then I did add a bonus, which is credit card debt. And that's not here. I just researched it a little, and it is leveling off to about the same level of growth, which is 4.9%, as we saw in the months before the pandemic. So things do seem to be approaching. There really are like flattening. All these graphs that I was looking at last night, flattening out to what is maybe slightly higher activity than pre-pandemic, but awful close. And the fact that it's approaching that and that it's flat suggests a little more stability and consistency than people maybe were assuming. We're either heading towards salvation or doom, but no, I think it's just normal life.
Yeah, exactly. It's just normal struggles.
Yeah,
and,
yeah.
and there's never rarely do we get to a point in the economic cycle where it's like it's all good, we're fine.
Yeah,
We're good.
yeah.
There's always a worry card. When it's really good, it's too good. What's right around the corner?
Oh, yeah, agreed. And I'm glad you have this employment map up here because it does show employment nationally at the state levels doing fine. I think Wisconsin and Michigan stand out with low unemployment in the Midwest, but it's also not hard to notice the low unemployment in the South and this kind of like this belt across several sunny states. Fairly low employment on that.
Yeah,
Sun belt.
all in the threes. Really nice.
Yeah. So things are not getting worse. Like I said before, I think they're getting better slowly, and it's been a while that this trend has been in place. I'll feel a little more comfortable about the long-term strength of the labor market. But even that's not too bad. We had strong jobs numbers. It's always a balance when it comes to labor market and inflation.
Say Louisiana has a 0%.
It does look like the
It's
employment,
the employment change. Sorry,
yeah.
the unemployment rate is 4.3%. Okay, that makes much more sense.
So, as for home sales specifically, sales have been slow for over 2 years, pretty much across the board. And currently, home sales are stalled with 7% mortgages.
There's no inventory. I mean, it's hard to buy a house, and there's very little inventory.
Yeah. This is a really revealing chart. So in the NAR article, they have existing home sales. This is new home sales. Everyone said that, oh, people are stopping. The lock-in effect is what they said. They said people are staying in their existing homes. The existing homes are not for sale. The ones that are really being bought hand over fist are new home sales. But you can see at this graph, that's not really the case. People are buying as many new homes now as they were a little bit before pre-pandemic. In the same spike in new home sales that occurred a little bit after 2020 when rates were really low, that same spike happened in existing home sales as well. So it doesn't seem like there is a trade between existing and new home sales. It just seems like there are less home sales because of high interest rates. Now, I say less but that's like a relative thing. I think that there certainly are less existing home sales, but relative to demand, you would assume that given the progression pre-pandemic that we'd have more new home sales now. It's just, I think, yeah. That is the increased cost of mortgage payments are really hurting home sales.
For as normal of a graph as this looks, you can make the argument saying the housing market seems pretty like healthy and normal, but it really doesn't feel normal at all because the situation of who can afford the mortgage to live in a home, to acquire it, the affordability aspect seems so abnormal, but everything else, it's still finding this interesting equilibrium between what's on the market and there's enough buyers there. And I would, this is interesting because it's not just, it's easy to believe that prices are about the same. They've increased a little bit year over year, certainly haven't fallen off a cliff.
Yeah.
I think the common assumption is that's on just low volume. And the reason that we're just seeing a lot fewer homes sold, and so there's less buyers on the market, but the number of buyers and homes for sale are lining up, and so pricing is is favorable. But this is basically saying that no, these new home builders, they're cranking out homes, and people are still buying them at the same rate as they did at the higher rate as 2018.
That's the new homes, and the new homes. These numbers are 600, 700,000.
And builders are giving concessions, and there are a lot more. And I would say there have been, if we could overlay this chart with new single-family home development also.
So if you go back into the NAR article, now they may be pulling on different data sources, but when it comes to existing homes are about 5 times typically the amount of new home sales, and the existing home sales really have fallen off a cliff.
And is that because on the new homes, builders are providing incentives, mortgage incentives? They're giving discounted rates.
That could be. I think just as likely is you got to kick someone out of their mortgage to get an existing home. You may not have to do that if it's a new home.
Good point. Those are just the homes that are available. Is what you're saying, and that's when I occasionally will look on the housing market, and I'm pretty much looking at existing homes. There's not a whole lot of options, but if you are looking to buy in a newer neighborhood, a new house, there are definitely builders who have homes available.
Yeah.
It makes sense.
But the surprise that I had, and as much as we said that new homes are relatively healthy, I think new homes took a hit because of high rates. I think existing homes took a hit because of high rates. So it's this both really happened, and I think both you could even say that it's even worse because I think that demand has gone up. Population has grown a little bit. Housing demand has gone up a little bit. There are these pressures. There's a pent-up demand. I think it's being held back by mortgage rates, and that could really stand to be released. I think that supposedly, so for existing homes, the census numbers are 3.76 million in sales. NAR has the number at 4.15, but either way, you get 5 times as many existing for new homes. I think I already said that, but still, it's an interesting moment that we're at in the housing market where there still is a lot of demand. There isn't any compelling story of home price loss or home value loss. It's this would have been
an interesting article, and I can see if I can look it up real quick. But I think there was just a report from it was like a Wall Street report that essentially said that the analysis is that single-family homes in the United States are overvalued anywhere between 10 and 20%, and those prices should come down. Now you can say that all you want, but unless those transactions have to happen. All right, man, I was able to find this article from the Wall Street Journal. Wall Street thinks U.S. homes are overpriced. Then subtext, housing could be overvalued by anywhere from 10 to 35% based on how investors are acting.
I think that, I mean, one other explanation is like home buyers are willing to pay more than investors. And we've seen that time and again where like the Wall Street will buy as cheap as they can. They don't have an emotional stake in it, so they're not going to buy with their heart, and oftentimes the heart will make you pay a little bit more.
100%, yeah.
And I also think that part of the American dream papers over a lot of repair costs and just like the burden. But if you look at it through like your Excel spreadsheets, then you realize, oh man, this is that's going to cost a water heater, the knob and tube wiring. You got to do that. So there, because a home buyer isn't making this transaction like hundreds of times or tens of times every year. This is like once, twice, three times a lifetime where they're thinking about this. So that's a part of the housing market that people don't really think about as much. I know that there are real estate agents that will guide you through this process, but mentally, that's got to be a big effect, a big difference between the investor buyer and the home buyer.
Yeah. Hey, Nat, so I'm reading this piece on the Wall Street Journal, and there's a comment that I would like for you to comment on, if you would entertain me.
Yeah.
Jim G. The spread in valuations explain why owner's equivalent rent, owner's equivalent rent or OER is used to compute housing costs in the CPI inflation calculation rather than comparable sales data. Owners are asked how much their home would rent for rather than the government simply looking at house prices. Owners don't think in terms of cap rates, so lowball their rent estimates. The result is that housing prices are underestimated in CPI by about 30%, similar to the discount on stock prices referenced in this article.
I don't really disagree. I think that's a pretty solid take on that. And it is revealing too that like, oh, so they're determining home prices based on just people asking. That's one thing you never do. I don't rent out my home every other month, so I don't know. How would I know? Yeah, and I wonder if CPI is like, hey, by the way, this is how you calculate it. Are they just asking?
Who are they surveying?
Yeah.
Who I know I've read about it, and apparently they mix it up, and it baffles the mind.
You don't want to tell people how to, because you want to give them that freedom to give their own answers, but also you want to tell them. I would tell them a little bit about cap rates and just be like, well, this is prevailing cap rates.
Yeah. I don't know.
I guess it gets
too
complicated. Yeah.
Yeah, that's okay. All right, so moving on from that, but staying on the NAR piece, looking at new listings, inventory. Looks like new listings are down a little bit, 1.8% a year over year. That's kind of nominal. That's kind of, again, sort of we've been talking about. Inventory has been declining overall, but there's been certainly like a push in the last year. Basically since throughout 2024, we saw an increase in inventory, kind of bring us back to 2020. I don't know if this is just delivery of single-family homes, of new homes, I guess would be.
It's really interesting to see, even pre-pandemic, the inventory, for sale inventory has these phases that almost last like a year, or they come up in the summer and then they go down in the winter and then they come up in the summer. So that the latest data that we have here is for August. So that really does align with, we could see a dip in inventory. Inventory could be lower than it is in this graph too.
Yeah.
Even so, but the more compelling trend is every year it seemed to, from 2016 until 2022, it seemed to go down, and now we're just almost a little bit up, but still not quite. So we've got a ways to go.
Well, and it makes up, because if you think of these housing starts kind of peaked in 2021, 2020, end of 2021, 2022, which makes sense because interest rates were still zero. This is kind of peak ZIRP, and it takes a minute for some of those houses to be built. And so then we had a little bit of a surge back up here in 2023, I guess the way.
And it makes so, and this is a little bit reassuring that like the market forces that are acting on the multifamily market and really making it hard to build are in a small part at least acting on the single family market. It's not like they were completely ignoring the high rates that were making it hard for apartment builders to build. So home builders, no matter what, they're not building as much as they would probably like to. I think that this is a case, whether you're building or whether you're trying to sell or buy, there's a lot more demand than there is capability for supply. It's sad.
Very true.
Numbers are low in the wrong places, and that is probably why the housing, the price of home prices have just kept up amid the high rates.
Yeah. Well, in terms of new residential construction, a lot being built in Connecticut, DC, 4,400 units. I mean, that's more than many other. That's more than New York at just under 2,000. Hawaii, 1,300. That's a lot. California, again, one of the most populous states, 650, which I think more is about shows how less just construction is going on in California. I guess.
Yeah.
Also, Texas is interesting. Not that much.
So this is they're taking the
population per single family building permit by state. So I guess the size of the population has a negative effect on the number.
So for every 186 permits, every 186 people?
The ratio is calculated by dividing the number of a state's population by the number of single family building permits issued in the state within 1 year.
That means that perhaps there's a lot of single family permits in Texas.
Yeah.
Wow. Okay. A lot of building.
This
and it makes sense that
this is a weird. I don't love.
I know it's not immediately, but it is interesting.
I understand what it's relative.
So then, if you looked at New York, you know why there's like 2,000 per building permit because they're not building a whole lot of homes there. But I think it's reversed, and I think it's messy.
Yeah, I don't love that. Okay, new residential construction. State year-over-year percentages changes of single-family building permits as of November 2024. Pretty much everybody's down. Again, we've seen this in multifamily building permits are way down, starts are down. Only a handful of states where they're positive. Ohio being one of those. Looks like they made an error here. And
they didn't even include Indiana. They mentioned Illinois twice.
They just mentioned Illinois twice. Thanks. That's what it's like living in the Midwest.
Yeah.
Anyway,
they fly right over you, no matter if they're in the plane or not.
But it's interesting, states like Wyoming still seeing growth, really in the Mountain West. The Dakotas still very positive. Minnesota, Wisconsin, Idaho, Montana. But then most other states pretty negative. I guess what do we got here? Just Delaware. We got Maine and Connecticut.
District of Columbia down 88.9% in terms of their building permits. Wow.
But then Alaska and Hawaii. Alaska has 66% year-over-year change in building permits, and Hawaii 50%. Interesting.
Yeah.
Okay. Well, this is a really good piece, Matt.
So
anything else on just general housing broadly?
Yeah. If we are going to talk about this is what I really wanted to get out of this is this state of the economy that we're in. We're still in a state where low supply, high demand in housing, whether you look at single family or multifamily. And the driver of this is still interest rates. And so that is something that I think probably the incoming administration is going to be sensitive about. And it is something that was mentioned in some of his speeches and stuff last night was about housing, and it is a concern. And I was reading some of the stuff on Trump's nominees. Like, they're not ignoring the housing crisis at all. They're not. They have their own solutions for it. So we'll have to see how that works and how that dovetails with inflation and interest rates. And
it will be interesting to see how the Trump administration tries to influence monetary policy at the Federal Reserve, or what they try to do on the fiscal side or at Treasury in like issuing bonds in order to effectively lower interest rates. The president's authority is, the Federal Reserve is technically a private organization. The president nominates the chairman of the FOMC, chairman of the Federal Reserve, but it's a private organization, so it's not like Trump can go in there and tell them where the FOMC where rates should be.
And there's like market forces for But you're saying that
Well,
they
that's where they could
overcome
have
that.
some impact is on the fiscal
Okay.
side.
Very interesting.
And so, I mean, if for example, if they were able to get the deficit under control, that should reduce the 10-year Treasury.
Okay.
Now they also have, but if they spend a lot, which they want to spend a lot, that could increase the deficit. They could have upward pressure on
Yeah,
the 10-year
yeah.
Treasury. They could change the way they're issuing bonds, and maybe and one big challenge right now is they just have all of this shorter term bonds that are coming due. Because they wrote a lot of just short term paper rather than having longer maturities. That needs to be converted to longer term maturities at some point, getting off like the 6-year and like the 2-year notes, pushing it some out to the 10 and the 20 or the 30. But the problem is the short-term rates are all so low. Then now we're borrowing at a much higher cost, and so if you can find a way to be able to get those rates down, we'll be able to reduce overall debt service of the United States would be very beneficial. But there's a balancing act because on one way, if they try to make progress on a variety of initiatives that cost money, including tax cuts.
Yeah.
That can increase inflation or increase interest rates. And then the opposite is true. I mean, if they stop spending, they won't be able to achieve some of their goals.
Yeah.
But they might be able to get rates down. So I think that really,
No, there is no contradiction in their aims nor in their methods that they use to accomplish them. I have complete trust in this incoming administration.
as no politician has before.
Yeah, that's right.